I don't know of any finance companies like Business Loan Express that are able to make good profits when they are forced to borrow money at 25%. I also don't know of any other companies that Allied charges 25% for its money. There's another Allied-controlled investment. It's called Hillman, which has a $40 million loan that Allied has set the rate at only 18%. This, of course, is in addition to whatever fees Allied charges Hillman. So there's another $7 million of intra-company income. Let's just talk now for a minute about how Allied generally values its portfolio. As I mentioned before, Allied does not provide for specific loan loss reserves. Instead, it marks its value to fair value as determined by the board of directors under the supervision of its auditors. So let's see what the auditors say. I'm going to read from the audit letter from the 10K that came out after the year 2000. So this is 1 year dated. I'm going to pick the third paragraph of the audit opinion where it says, as discussed in Note 2, the consolidated financial statements include investments valued at $1.78 billion as of December 31st, 2000, and $1.2 billion as of December 31st, 1999. This is 96% and 95% of the respectively of the total assets, whose values have been estimated by the board of directors in the absence of readily ascertainable market values. We have reviewed the procedures used by the board of directors in arriving at its estimated value of such investments and have inspected the underlying documentation, and in the circumstances we believe the procedures are reasonable and the documentation appropriate. However, because of the inherent uncertainty of valuation, the board of directors' estimate of value may differ significantly from the values that would have been used had a ready market existed for the investments, and the differences could be material. But now let's turn to the most recent 10K filing, where we have the audit from the year that came in at the end of 2001. And this paragraph reads substantially the same as the paragraph I just told you, except the numbers have changed a little bit, except there's one sentence that has disappeared. The sentence that disappeared, it was the sentence that said, we have reviewed the procedures used by the board of directors in arriving at its estimate of fair value of such investments and have inspected the underlying documentation, and in the circumstances we believe the procedures are reasonable and the documentation appropriate. So apparently now, the auditors maybe didn't review or inspect the underlying documentation or the procedures. Maybe they don't think the estimate of the value of such investments is right, or they've inspected the underlying documentation. Maybe they don't know if they've arrived at the correct value or procedures are reasonable under the circumstances. We asked the CFO about this and to explain why did the audit language change. And what she told us was that the language change was dictated by a change in the audit guide. So we consulted our own accountants, who consulted the various editions of the audit guide. And they were unable to explain any change in the direction for what the language should be from one audit guide to the next over the last couple of years. So it must be another explanation. I think the explanation actually is I forgot to tell you, the auditor here is Arthur Andersen. And at the end of 2001, they may not have wanted to feel quite so comfortable about some of these valuations. But that's just one man's speculation. Let's move on to the CMBS portfolio for just a moment. Here we have a $700 million CMBS portfolio. They own first loss tranches of highly levered securitizations. Most of the securitizations were done in the last 3 years, so the portfolio is unseasoned. Allied carries the whole portfolio at cost. They cite the low delinquency rate of the underlying mortgages to back up their valuation. My only observation is that national office vacancy rates have about doubled in the last year, and rents are falling. It may take a while before this leads to landlord delinquency, defaults, and ultimately credit loss, but it seems to me that the portfolio of non-rated first loss tranches in highly levered CMBS pools that were mostly underwritten just ahead of the recession is, let's just say, a dicey proposition. Back to the finance portfolio. This is the main part of their business, and I told you about some of the loans and how they were carrying them before. They have what Allied does is they have a 5-point rating system. They rate the loans on a scale of 1 to 5. A loan rated 1 means that they expect to make a gain on the equity component of their mezzanine investment. Here they do their own valuation, comp or company analysis, discounted cash flow, whatever, and they figure out what the warrants are worth and they mark them up to what they think the fair value is. Loans rated 2 are performing as expected and they're carried at par. Loans rated 3 are on what they call the watch list. Companies on the watch list are probably performing below plan. They may have tripped financial or other covenants. They may require fresh money from ALD, or that's Allied, excuse me. But Allied does not believe that it will lose any principal or interest. Again, this may be based on their own DCF or comparable company analyses. Allied carries these loans at par. We asked why grade 3 loans are not written down, since there has been deterioration. Presumably, the loan is worth less than it was on the day that it was underwritten. According to the head of investor relations, investments are marked down only when we believe that there has been a permanent impairment in the value. Once we mark it down, we don't believe we will recover the investment. I wish I could only mark down my investment losers when I believed that there was a permanent impairment of the value. I interpret her answer to mean that the company marks the loan to the maximum recovery value, rather than what I would view at least as fair value. In my experience, when a credit underperforms, even if I think it will pay all of its interest and principal, spreads widen, debt instruments issued at par become worth 95 cents or 90 cents or less. Anybody want some WorldCom? This does not seem to happen at Allied, where investments continue to be marked at par. In fact, in the most recent quarter, Allied announced that they had bought senior debt from the banks in companies where they own the mezzanine debt. Allied was enthusiastic that they were able to buy this debt at a discount. It seems to me if the senior debt is available at a discount, the sub-debt is in worse shape. It appears that Allied continues to mark this sub-debt at par in these cases. Loans rated 4 means that Allied expects to lose some interest but no principal. Loans rated 5 mean that the principal is impaired. These loans get written down, I guess, to the value they expect to eventually recover. According to the company IR lady, there is no time limit on our investments. We could keep them at some level of value as long as something is being done to try to recover the investment. They cite this as a positive benefit, unlike a bank that has to recognize charge-offs to satisfy regulators. I asked for an example of an investment where their patience paid off. The company could not cite one loan in the last 3 years where they carried the loan at a discount, they were patient, and they eventually got a better recovery. Last year during the recession, Allied had credit losses of around 1% of the portfolio. This is about the same as it has been in previous years. They must be great underwriters. According to Moody's last year, 12% of high-yield bonds defaulted. The 5-year average default rate is about 6%. I would argue that Allied's portfolio is probably at least as risky as high-yield bonds. The companies Allied lends money to tend to be smaller than high-yield issuers, and almost all of them do have access to public equity markets. I'm sorry, almost none of them have access to public equity markets. Needless to say, I am suspicious of the low credit loss reported by Allied, given the types of loans they make and the performance of other portfolios of loans in the recession. Did anyone notice how Finova's portfolio performed? The valuation here, the bull case, is supported by the dividend yield. As I said, the company pays out the earnings as a dividend. The $2.20 that they pay out right now provides a yield of over 8%. Part of the question is how do they generate the dividend? Last year, they paid $180 million in dividends. About $65 million came from non-cash or PIK interest in dividends from companies that they invested in. Now, there's nothing wrong with non-cash interest, provided that you're comfortable that the money will be collected and the portfolio is being fairly marked. As we have seen, this requires a leap of faith. I want to point out now that if you generally don't recognize impairments until loans become delinquent, and if you do not require cash interest in the first place, you may wind up understating the delinquency statistics, and you may not properly account for troubled credits. Anyway, since Allied has to pay out all of its earnings as a dividend, in order to fund the $65 million shortfall, the dividend requirement between the 65% shortfall between the dividend requirement and the earnings, the cash earnings, if you would, Allied is ultimately limited in how much it can borrow. It must eventually sell equity in order to raise the capital to pay the dividend. When the dividend is paid from the proceeds of newly sold shares, in effect, the company is taking money from new investors to satisfy the income requirements of the existing investors. There's a name for that.